Let me ask you something that most financial advisors will never discuss with you. What happens to your $1.5 million if we enter a genuine economic depression? Not a recession, not a market correction, a depression. The kind of prolonged economic contraction that destroys wealth, wipes out retirement accounts, and forces people to start over from nothing. Most people think depressions are relics of history. They think the Great Depression was a one-time event that could never happen again. They think the Federal Reserve and the government have learned enough to prevent that kind of catastrophe. They're wrong, and I've spent my entire career studying exactly how and why they're wrong. I predicted the 2008 financial crisis years before it happened. I saw the housing bubble when everyone else was celebrating rising home prices. I bet against the mortgage market when Wall Street called me crazy, and I made hundreds of millions of dollars when the system collapsed exactly as I said it would. Not because I am smarter than everyone else, because I was willing to look at data that made people uncomfortable. I was willing to ask questions that nobody wanted to answer, and right now, those same uncomfortable questions are screaming at me again. The data is telling me that we're approaching economic conditions that could trigger something far worse than 2008. Something that could make the COVID crash look like a minor inconvenience. Something that requires a completely different approach to wealth preservation than what most people are doing. If you have $1.5 million saved for retirement, this might be the most important thing you ever hear, because the strategies that worked for the last 40 years are not going to work for the next 10. The traditional balanced portfolio of stocks and bonds is going to get destroyed. And unless you understand why and prepare accordingly, you could lose half your wealth or more. Let me take you back to 2005. I was running a small hedge fund called Scion Capital. We had a few $100 million under management. Not huge by Wall Street standards, but significant enough that I had access to data and research that most retail investors never see. I was analyzing mortgage-backed securities. These were bonds created by bundling thousands of home mortgages together. Wall Street was selling these things as safe investments, triple, A-rated, backed by American homes. What could go wrong? Everything could go wrong. I spent months digging into the actual mortgages underlying these securities. I found loans made to people with no income verification. Loans where the borrower couldn't afford the payment even at the initial teaser rate. Loans where the only way the borrower could survive was if home prices kept rising forever so they could refinance. I remember sitting in my office, staring at spreadsheets, realizing that billions of dollars of supposedly safe securities were backed by loans that were going to default. Not might default, were going to default. The math was undeniable. These borrowers could not afford these homes. When the adjustable rates reset higher, they would stop paying, and when they stopped paying, the securities would collapse. I tried to tell people. I wrote letters to investors explaining what I was seeing. Most of them thought I was paranoid. Some of them pulled their money out because they didn't want to be associated with someone making such negative predictions. But I kept digging, and the more I dug, the worse it looked. What really terrified me wasn't just the mortgages. It was the derivatives built on top of the mortgages for every dollar of actual mortgages. There were $10 or $20 of synthetic exposure through credit default swaps and collateralized debt obligations. The entire financial system was leveraged to an assumption that home prices would never fall nationwide. When that assumption proved false, the leverage would amplify the losses into something catastrophic. I was right. By 2008, the system collapsed. Bear Stearns failed. Lehman Brothers failed. AIG had to be bailed out. The stock market fell 50%, unemployment doubled. Millions of people lost their homes. It was the worst financial crisis since the Great Depression. But here is what most people don't understand. 2008 could have been much worse. The Federal Reserve and the Treasury Department intervened with trillions of dollars of support. They bailed out banks. They bought toxic assets. They pushed interest rates to zero. They did everything in their power to stop the bleeding, and it worked. Sort of the economy recovered, asset prices recovered. By 2013, the stock market had made new highs. Everyone breathed a sigh of relief and went back to business as usual. But the intervention didn't solve the underlying problems. It papered over them, it pushed them into the future. And now those problems are back. bigger than ever, with less room to maneuver. Today, I am going to share with you the framework I would use to preserve $1.5 million through a genuine economic depression. This isn't theoretical. This is based on decades of studying financial crises, analyzing what worked and what didn't, and understanding the specific vulnerabilities in today's economy. I am going to give you 5 specific strategies, 5 ways to position your wealth so that even if the worst happens, you come out the other side with your financial security intact. These aren't get-rich, quick schemes. They're survival strategies. They're designed to protect what you have, not to make you wealthy, because in a depression, the goal isn't to get rich. The goal is to not get poor. The second most important strategy for depression, proofing $1.5 million, is maintaining significant cash reserves. And I mean actual cash or cash equivalents, treasury bills. Money market funds backed by government securities, things that will be there no matter what happens to the banking system. Most financial advisors tell you that holding cash is a mistake. They say inflation will eat away at your purchasing power. They say you are losing money by not being invested. And in normal times, they're right. Cash is a drag on returns when the economy is growing and asset prices are rising. But a depression isn't normal times. In a depression, cash is king. Cash gives you options when everyone else is desperate. Cash lets you buy assets at fire sale prices when others are forced to sell. Cash means you don't have to liquidate your investments at the worst possible moment. During the Great Depression, the people who preserved their wealth weren't the ones who stayed fully invested in stocks. The stock market fell 89% from peak to trough. 89% if you had $1.5 million in stocks in 1920. You had about $165,000 by 1932. That is not a recovery you live to see. That is generational wealth destruction. The people who preserved their wealth were the ones who had cash when the crash came. They bought real estate for pennies on the dollar. They bought stocks at valuations that seem unimaginable today. They emerged from the Depression wealthier than they went in, not because they were geniuses, but because they had the liquidity to act when others couldn't. I would keep at least $450,000 of that $1.5 million in short-term Treasury securities. That is 30%. I know that sounds extreme. I know you are giving up potential returns. But in a depression scenario, that $450,000 becomes your foundation. It is the money that lets you survive the initial shock. It is the money that lets you pay your bills when your other investments are frozen or worthless. It is the money that lets you buy assets at depression prices when the opportunity arises. Now you might be thinking, what about bank accounts? Aren't those safe? Aren't they insured by the FDIC? Yes, bank accounts are insured up to $250,000 per depositor per institution. And in a normal crisis, that insurance is reliable. But in a true depression, especially one involving a banking crisis, the FDIC's resources could be overwhelmed. The insurance fund has about $120 billion. The banking system has trillions in deposits. If multiple large banks fail simultaneously, the insurance fund isn't big enough. This isn't paranoia. This is math. I am not saying the FDIC will fail. I am saying that in a worst-case scenario, you don't want your survival to depend on the government's ability to backstop a banking collapse. Treasury bills held directly or through a treasury. Only money market funds are backed by the full faith and credit of the United States. They're the safest asset that exists. In a depression, safety matters more than returns. The most important strategy for preserving wealth through a depression is owning physical gold. Not gold ETFs, not gold mining stocks. Physical gold that you possess or that is held in allocated storage in your name. I know this sounds old-fashioned. I know gold doesn't pay dividends. I know modern portfolio theory says gold is a relic, but modern portfolio theory was developed during a period of relative stability. It assumes that the financial system will always function. It assumes that the government will always honor its debts. It assumes that there won't be a crisis severe enough to threaten the entire monetary order. Those assumptions may not hold in a depression. Gold has preserved wealth through every financial crisis in human history. It preserved wealth through the Great Depression. It preserved wealth through the collapse of the Weimar Republic in Germany. It preserved wealth through the fall of the Roman Empire. It has a 5,000-year track record of maintaining purchasing power when paper currencies fail. During the Great Depression, gold actually increased in value. President Roosevelt raised the official gold price from $20.67 per ounce to $35 per ounce in 1934. That is a 70% increase during the worst economic collapse in American history. People who held gold saw their purchasing power increase while everyone around them was losing everything. Now, I am not predicting that we're going to return to a gold standard. I am not predicting that the dollar is going to collapse. What I am saying is that gold provides insurance against scenarios that are difficult to predict but potentially catastrophic. And when you are trying to preserve $1.5 million, insurance matters. I would allocate $300,000 to physical gold. That is 20% of the portfolio. You can store it in a secure vault with a reputable custodian. You can keep some in a home safe. The key is that it needs to be real physical gold that you have clear legal ownership of. Not a promise to deliver gold, not exposure to gold prices, actual metal. The advantage of physical gold in a depression isn't just the price appreciation, it is the liquidity in extreme scenarios. If the banking system freezes, if markets close, if there is a genuine breakdown in the financial infrastructure, physical gold can still be exchanged. It has been money for 5,000 years. It will still be money when the current crisis passes. The third strategy is to own productive real estate with minimal debt. I am talking about properties that generate income, rental houses, small apartment buildings, commercial properties with stable tenants, things that people need regardless of economic conditions. Real estate is tricky in a depression because property values typically fall significantly. In the Great Depression, real estate prices fell roughly 30 to 40% nationally, and much more in some areas if you are leveraged, if you have a mortgage. That price decline can wipe you out. You end up owing more than the property is worth, and if your tenants stop paying rent, you can't make the mortgage payment. But real estate with little or no debt is a different story. If you own a property outright, you don't have a mortgage payment to make. You can survive even if rents fall or vacancy increases. You are not going to lose the property to foreclosure because there is nothing to foreclose on. And meanwhile, you are collecting whatever rent the property generates. The key is buying the right type of property. In a depression, luxury properties get crushed. Vacation homes become worthless. High-end retail space sits empty. But basic housing, affordable apartments, properties that serve essential needs, these maintain value better because people still need somewhere to live. I would allocate $300,000 to income, producing real estate owned free and clear. This might mean a small apartment building in a stable market. It might mean a couple of single-family rental houses in areas with diversified employment. The specific property matters less than the principle. Own something real. Own something that generates income. Own it without debt so you can survive a prolonged economic contraction. One of the mistakes people make with real estate is buying it for appreciation rather than income. They buy properties that barely cover their expenses, betting that the value will go up over time. In a depression, values go down. If you bought for appreciation, you are stuck with an asset that is declining in value and generating no income. If you bought for income, at least you are getting cash flow even while you wait for values to recover. The fourth strategy is to hold short-term treasury bonds, not long-term bonds. This distinction is crucial and most people get it wrong. When interest rates are low, investors reach for yield by buying longer duration bonds. A 30-year treasury pays more than a 2-year treasury. So people load up on long-term bonds thinking they're being conservative. But long-term bonds have significant interest rate risk. If rates rise, the price of those bonds falls. And in certain depression scenarios, rates can rise dramatically. This seems counterintuitive. Most people think that in a depression, interest rates fall because the economy is weak. And that is often true in the initial phase. The Federal Reserve cuts rates to stimulate the economy. Bond prices rise. But if the depression is accompanied by a loss of confidence in the currency or the government's ability to service its debt, rates can spike. Look at what happened in the 1970s. inflation got out of control. The Federal Reserve had to raise rates to 20% to break the inflationary cycle. Long-term bondholders were devastated. A 30-year Treasury bond purchased in 1970 lost roughly half its real value by 1980. In a severe depression, especially one caused by government debt or currency concerns, we could see a similar dynamic. The government might have to print money to fund stimulus programs. That printing could cause inflation. That inflation could cause interest rates to spike, and long-term bondholders would be crushed. By contrast, short-term Treasury securities have minimal interest rate risk. If you own a Treasury bill that matures in 3 months, you are not going to lose much even if rates spike. You just roll it over into a new bill at the higher rate. Your principal is protected. I would keep any bond allocation entirely in short-term Treasuries. Bills maturing in 1 year or less, you give up some yield compared to longer-term bonds. But you eliminate the risk of getting caught by a sudden rate spike. In a depression scenario, that protection is worth far more than the extra yield. The fifth strategy is maintaining a modest allocation to high-quality equities, but only businesses that can survive and even thrive in a depression. This is where most people get it completely wrong. The instinct in a potential depression is to sell all your stocks. And for most stocks, that instinct is correct. Companies with high debt, cyclical businesses, discretionary consumer goods, financial institutions, these all get crushed in a depression. Many of them go bankrupt. Owning them going into a depression is a recipe for massive losses. But some businesses actually do well in depressions. Companies that sell things people need regardless of economic conditions, food, basic utilities, essential health care, these businesses see stable or even increased demand when the economy contracts. People cut back on vacations and restaurants, but they still need to eat, heat their homes, and take their medications. The key is to own these businesses at reasonable valuations and with minimal debt. A company that might survive a depression but is trading at 50 times earnings is still a bad investment. You need to buy quality at a fair price. I would allocate about $150,000 to high-quality defensive equities, consumer staples companies that have survived previous depressions, utilities with stable regulated returns, healthcare companies that provide essential services. These won't make you rich in a depression, but they won't go to zero either. They'll pay dividends, they'll maintain some value. And when the depression ends, you'll still own pieces of productive businesses. The specific companies matter less than the characteristics. Low debt, essential products or services. History of surviving previous economic contractions. Reasonable valuation. Dividend payments that can be maintained even in tough times. If a company meets those criteria, it belongs in the depression proof portion of your portfolio. Let me bring all of this together and show you how these 5 strategies work as a unified framework. The principle underlying all of this is optionality in a depression. You don't know exactly what is going to happen. You don't know if it will be deflationary or inflationary. You don't know if the banking system will survive or collapse. You don't know if the government will be able to respond effectively or if it will make things worse. What you need is a portfolio that can survive multiple scenarios. Cash gives you optionality if the financial system freezes. Gold gives you optionality if the currency weakens. Real estate gives you optionality because you own something real that generates income. Short-term treasuries give you optionality because you can quickly reinvest as conditions change. And defensive equities give you optionality because you maintain exposure to productive businesses. No single strategy is perfect. Cash loses value to inflation. Gold pays no income. Real estate is illiquid. Short-term treasuries have low returns. Defensive equities can still fall significantly, but the combination of all 5 creates a portfolio that can survive scenarios that would destroy a traditional stock and bond allocation. Think about what happens to a traditional 60-40 portfolio in various depression scenarios. If we have a deflationary collapse like the 1930s, the equity portion falls 70 to 90%. The bond portion might hold value, but you've still lost catastrophic amounts. If we have an inflationary depression, like some emerging markets have experienced, both stocks and bonds get destroyed. The only protection is real assets like gold and property. My proposed allocation handles both scenarios. In a deflationary collapse, the cash and short-term treasuries hold their value. The gold maintains purchasing power. The real estate generates income even as values fall. The defensive equities fall less than the market. You survive with most of your wealth intact. In an inflationary depression, the gold spikes in value. The real estate holds its value in real terms because rents can be raised. The short-term treasuries can be rolled into higher yielding securities as rates rise. The cash loses some purchasing power, but it is only 30% of the portfolio. Again, you survive. This framework isn't designed to make you rich. It is designed to make sure you are not poor when the crisis passes. And for someone with $1.5 million, that is exactly the right goal. You already have enough to live comfortably. The objective is to keep it, not to double it. Now, let me talk about the practical application. How do you actually implement this strategy? For the cash position, open a Treasury Direct account with the government. You can buy Treasury bills directly without any intermediary, no brokerage risk, no bank risk, just a direct claim on the United States government. You can also use a Treasury-only money market fund, like the ones offered by Fidelity or Vanguard. But understand that adds a layer of institutional risk between you and the Treasuries. For the gold position, work with a reputable dealer, buy standard bullion coins like American Eagles or Canadian maple leafs. Avoid numismatic coins with collector premiums. You want gold for its metal value, not for collectability. Store some at home in a quality safe. Store the rest in allocated storage with a company like Brinks or the Perth Mint. Allocated storage means the gold is specifically yours, not part of a pool that could be subject to claims from other parties. For the real estate position, focus on markets with stable employment bases, university towns, state capitals, areas with diversified economies that don't depend on a single industry. Look for properties that generate positive cash flow at current rents. Assume rents will fall 10 to 20% in a depression and make sure you can still cover expenses. For the short-term Treasury position, ladder your maturities. Buy some bills maturing in 1 month, some in 3 months, some in 6 months, some in a year. This gives you regular liquidity while maximizing yield within the short-term constraint. For the defensive equity position, stick with the largest, most stable companies. Companies that have paid dividends for decades, companies with fortress balance sheets, companies that weathered the Great Depression, the financial crisis, and every recession in between. Don't try to get clever or find undiscovered gems. In a depression, you want boring and reliable. Monitor your allocations quarterly and rebalance when they drift significantly. If stocks fall and gold rises, sell some gold and buy more stocks. If real estate values drop, consider adding to your position. Rebalancing forces you to buy low and sell high, which is the opposite of what most investors do emotionally. What I really want you to understand is the mindset behind this strategy. It is not about predicting exactly what will happen. I don't know if we'll have a depression. I don't know when it might start. I don't know how severe it might be. What I know is that the risks are elevated. Government debt levels are at historical extremes. The financial system is leveraged in ways that most people don't understand. Central banks have fewer tools than they did before previous crises. And the complacency is deafening. Everyone assumes that the authorities will prevent the worst outcomes. That assumption may prove catastrophically wrong. When I made my bet against subprime mortgages, I wasn't certain the system would collapse. I estimated the probability at maybe 30 or 40%, but even a 30% chance of a catastrophic outcome justified taking protective action. The potential loss if I was wrong was modest. The potential gain if I was right was enormous. The same logic applies here. Even if you think a depression is unlikely, even if you estimate the probability at only 10 or 20%, the severity of the potential outcome justifies protection. Losing 30% in a normal recession is painful but recoverable. Losing 70% in a depression is life-changing, especially for someone at or near retirement. This is about asymmetric risk management. You are giving up some potential returns in the good scenario to protect against catastrophic losses in the bad scenario. That trade-off makes sense when you have enough wealth that preservation matters more than accumulation. I think about this constantly. Every time I look at the data, every time I see another warning sign, I ask myself whether I am being paranoid or prudent. And every time, I come back to the same conclusion. The risks are real, the potential consequences are severe, and the cost of protection is modest. If I am wrong and we have another decade of economic growth, a portfolio structured this way will still generate reasonable returns. You'll make less than someone who is fully invested in stocks, but you'll make enough. You'll sleep well. You'll have flexibility. If I am, right? And we have a severe economic contraction, you'll be one of the few people who emerges with their wealth intact. You'll have the resources to take care of your family. You'll have the ability to capitalize on opportunities that only appear in the darkest times. You'll be a buyer when everyone else is a desperate seller. That asymmetry is what makes this approach compelling: limited downside in the good scenario, preserved wealth in the bad scenario. That is how you survive when you don't know what is coming. The people who lost everything in past depressions weren't stupid. They weren't reckless. Many of them were following the best advice available at the time. They owned blue-chip stocks, they had diversified portfolios, they trusted the system failed them. It might fail again. The only responsible approach is to prepare for that possibility while hoping it doesn't happen. That is what preserving $1.5 million through a depression really means. It means being ready for the worst while living for the best. This framework has given me peace of mind through years of volatility, through 2008, through the COVID crash, through every scary headline and market panic. Because I know that no matter what happens, I'll survive, I'll have resources. I'll have options. That peace of mind is worth more than any amount of additional returns. It lets you live your life without constant anxiety about the financial system. It lets you make decisions based on what is right rather than what is desperate. It lets you be the calm presence when everyone around you is panicking. $1.5 million is a significant sum. It represents years or decades of work and sacrifice. It represents security for you and your family. Don't risk it on the assumption that nothing bad can happen. Prepare, protect, preserve, and whatever comes next, you'll be ready. Let me address something that I know many of you are thinking right now. You are thinking that this sounds too pessimistic. You are thinking that the economy has always recovered. You are thinking that betting against America has always been a losing bet. And you are right about the history. America has survived every crisis. The economy has always recovered eventually. People who stayed invested for the long term have generally done well. But here is what that analysis misses. For individual investors, especially those at or near retirement, the timing of a depression matters enormously. A 25-year-old who experiences a depression has decades to recover. They can keep working. They can keep investing at lower prices. They can wait for the recovery. A 65-year-old doesn't have that luxury. If you retire with $1.5 million and immediately experience a 50% market decline, you don't have time to wait for recovery. You need to live on that money now. You are forced to sell at depressed prices to pay your bills. By the time the market recovers, you've already depleted your portfolio. This is called sequence of returns risk. It is the risk that bad returns early in retirement devastate your portfolio even if good returns come later. And a depression is the ultimate sequence of returns risk. It is not just bad returns. It is catastrophic returns at exactly the wrong time. The strategies I've outlined are specifically designed to address sequence of returns risk. The cash and short-term treasuries provide income without forcing you to sell depressed assets. The gold and real estate maintain value when paper assets collapse. The defensive equities recover when the depression ends. You are not betting against America. You are insuring against a temporary period. When America is struggling, the insurance has a cost. You give up some returns in good times, but the insurance also has a benefit. You survive the bad times with your wealth intact. Think about how you approach other forms of insurance. You have homeowners insurance even though your house probably won't burn down. You have car insurance even though you'll probably never have a major accident. You accept a certain premium in exchange for protection against unlikely but devastating events. This is the same principle applied to your investment portfolio. A depression is unlikely but devastating. The strategies I've outlined are a form of insurance. They have a premium in terms of lower expected returns. They have a benefit in terms of protection against catastrophic losses. The question isn't whether you should have insurance. The question is how much insurance is appropriate given your situation. For someone with $1.5 million who is depending on that money for retirement security, I believe significant insurance is appropriate. The downside of being uninsured is too severe. I also want to address the timing question. People always ask me when the crisis will happen. Is it next year? 5 years from now? 10 years from now? And the honest answer is, I don't know. Nobody knows. The timing of these events is inherently unpredictable. What I can tell you is that the conditions are ripe. The debt levels are unsustainable. The financial system is fragile. The political divisions make coordinated response difficult. The central banks are constrained by their already bloated balance sheets. All the ingredients for a crisis are present. When exactly those ingredients combine into an actual crisis is impossible to predict. This uncertainty is actually an argument for acting now rather than waiting. If you knew the crisis was coming next year, you could stay invested until then and move to safety at the last minute. But you don't know. It could be next month, it could be 5 years from now. And moving to a protected position takes time. If you own stocks in taxable accounts, selling them triggers capital gains taxes. You need to plan for that. If you want to buy physical gold, finding a reputable dealer and arranging storage takes time. If you want to buy income, producing real estate, that can take months to find the right property and close the transaction. Start now. You don't have to do everything at once. Begin transitioning your portfolio gradually, sell some stocks each month. Build up your treasury position. Research gold dealers, start looking at real estate markets. Make progress even if you can't complete the transformation immediately. The worst outcome isn't being early to a defensive position. The worst outcome is waiting too long and getting caught by the crisis. I was 2 years early on the subprime trade, 2 years of carrying costs and criticism. But when the crisis hit, I was positioned correctly. Being early is far better than being late. I've spent my career studying financial history. I've read accounts of every major crisis going back centuries. And the pattern is always the same. Before the crisis, experts explain why it can't happen. During the crisis, everyone pretends they saw it coming. After the crisis, everyone promises it won't happen again. We're in the first phase now. The experts are explaining why a depression can't happen. The Federal Reserve is too smart. The financial system is too regulated. The government has too many tools. These arguments sound compelling until they're proven wrong. I remember the same arguments before 2008. Housing prices couldn't fall nationwide because they never had. The financial system was too interconnected to fail. The rating agencies wouldn't have given triple. Ratings to bad securities, every single one of those arguments was wrong. The arguments today are no different. They're reasonable, sounding explanations for why the comfortable status quo will continue. And they might be right. Maybe this time really is different. Maybe the authorities have everything under control. Maybe my concerns are overblown. But if I am right, even partially right, having $1.5 million properly positioned will be the difference between financial security and financial devastation. That asymmetry drives everything I do. I'd rather be wrong and slightly poorer than right and devastated. The people I feel sorry for are the ones who will be blindsided. The retirees who trusted their financial advisors and stayed fully invested. The people who didn't understand the risks they were taking. The families who did everything right by conventional standards and still lost everything because the conventional standards were wrong. You don't have to be one of those people. You can take steps now to protect yourself. You can implement the strategies I've outlined. You can build a portfolio that survives whatever comes next. Will it be easy? You'll have to overcome the inertia of your current portfolio. You'll have to resist the pressure from advisors who tell you to stay invested. You'll have to accept lower returns in the short term for protection in the long term. You'll have to be different from most investors at a time when being different feels uncomfortable. But being different is what saved my investors in 2008. Being different is what preserves wealth when everyone else is losing it. Being different is the price of financial security in an uncertain world. I've given you the framework. I've explained the reasoning. I've shown you how to implement each strategy. Now the choice is yours. You can continue with a traditional portfolio and hope for the best. Or you can take protective action and be prepared for whatever comes. I know what I would do with $1.5 million. I've told you exactly what that is. Whether you follow this path or chart your own course, at least you are now aware of the risks that most people are ignoring. At least you have the information to make an informed decision. That is really all I can do. Share what I see, explain what I think, and hope that the people who listen are better prepared than those who don't. The rest is up to you. The world doesn't care what we expect or hope. The world does what it does. Our job is to be ready, to have positioned ourselves so that whatever happens, we survive. That is the essence of preserving wealth. Not predicting the future, not timing the market, just being positioned to survive the range of possible outcomes. $1.5 million properly positioned can provide security through almost any scenario that security is worth protecting. That security is worth the cost of the strategies I've outlined. That security is what separates those who thrive from those who barely survive when the next crisis arrives.